lecture. Okay, so today's lecture we're moving away from revenue, right? So revenue was ended last week Friday with that big example. We ended revenue, and now we move on to inventory. What you're going to notice with inventory, especially the first few lectures, it's actually a mirror image of what we did in revenue. Yeah. So in revenue, we did it from the seller's perspective, right? In inventory, we're going to do a similar transaction, but from the buyer's perspective, right? So you're going to see there's like a mirror image going on here, especially when it comes to the initial cost, the first few lectures, like the first 2 or 3 lectures. And then after that, it gets a bit more like deep into inventory. Okay, so that's the important part. Yeah, so let's have a look at, so we're in chapter 13 now, right? So last chapter, the last lesson, we're in chapter 4. Now we jumped into chapter 13. Okay, so I just wanted to chat to you a little bit about what our plan is and where we're going with today's lectures. So in today's lectures, what we're going to do is, in the first lecture, we will have a look at inventory and understand why we consider inventory an asset, right? That's going to be a discussion on why inventory is an asset. Then we very briefly are going to go over the periodic and the perpetual inventory systems. These are obviously inventory systems that you guys have seen before. Some of you may have seen it at school. Others may have not done accounting at school, and you would have seen it in first year. So we're not going to spend a lot of time on that, and the reason being is because it is sort of old for the class, right? So we've got some exposure to it in the past, and therefore I would encourage you on those topics to go back and have a look at your prior year's work. So look at your first year's work and just revise what periodic and what perpetual means and how it works. We will briefly just look at some journal entries now, but I want you just to revise that and make sure that you go through that and understand it, right? Okay, and then in the second half of today's lecture, we are going to start compiling the costs of inventory, right? So basically, we're trying to build the costs of inventory. It sounds strange, but you'll sort of see what I mean when we actually start talking about it in more detail. So we're going to look at different costs that could be part of inventory, and we will decide whether or not they should be part of inventory, right? And I'm going to give you some principles and some things to think about whether or not a cost is in inventory. We're going to do that in 3 broad steps. The first step that we're going to look at is we want to look at purchasing costs. Some people might call that the cost price, right? The cost price of the goods. In accounting, we call that initial recognition, and you'll see that word initial recognition. I'm hoping that you saw it last year, but if you didn't, you'll see it a lot this year, especially when we start talking about PPE and intangibles and such, right? You'll hear about initial recognition. So we're going to start off with inventory. We're going to do that initial recognition first, right? And in that initial recognition, it's going to be that cost price that our supplier has charged us. Okay, so that's what we're going to start off with. We're also going to touch a little bit in the second half of our lecture. We're going to touch a little bit on conversion costs. However, the bulk of conversion costs will be done and completed in Thursday's lecture. So we're just going to introduce the topic of conversion costs. We're not going any deeper than just an introduction for now. And then we're going to finish it up on Thursday, and even on Friday, we're going to go even more in depth into conversion costs. So conversion costs is quite a big area in our study of inventory. What is important, guys, is that with conversion costs, you need to understand that a lot of focus will be placed on conversion costs in your tests and exams, right? So I need you to be super, super comfortable with this concept of conversion costs, right? Very important. Okay, then other costs, we're going to just touch on other costs and just do a little bit of stuff on other costs. It's not going to be too hectic. And we're also going to leave out one or two things that we are not going to do in other costs. So I'll tell you about that when we get to it, though, right? So after we have initially recognized, so that's initial recognition. After we've initially recognized the cost of inventory, we now need to find a way to allocate that costs to individual units, right? Or to individual items, right? And so we would have learned this last year about the different methods that we can do that. So we can do that using the FIFO method, which is the first in, first out method, right? Most of us remember that, I'm hoping, right? And then we've got the weighted average method, right? So that's the WAM method, so FIFO, and then weighted average. And then we've got the last one, which is the specific identification, right? Where we specifically identify each um, inventory item, and we actually have basically we account for them separately as opposed to accounting for them as a group, right? So that's the three methods that we're going to look at. Now, this is critically important that you write this down somewhere, right? We're not doing FIFO, WAM, and specific identification in depth. So therefore, it is very, very, very important that you go back to your last year's notes and look at these topics, right? We're just gonna breeze over it because I'm assuming that you know this already. I'm assuming that you're familiar with it and you know how it works, and therefore I'm not spending a lot of time on FIFO and WAM and specific identification. We're just gonna literally we're just touching on it because our syllabus in this section is so full that we can't waste time doing work that you already have done before, right? Number one, we can't do that. Number two, if I do go in depth into these FIFO and WAM and specific identification, you guys are going to get super bored because it's something that you've done before and you sort of know what's going to happen. So therefore, what you're going to have to do is you're going to have to go back to your first year notes and revise the section on your own. And then if you don't have first year notes, so if you one of the students that have transferred over, or maybe you were doing some other subject that eventually got you into back to 100, you can then rely on the textbook, and the textbook is comprehensive when it comes to this topic, right? So it's comprehensive, so you can really rely on the textbook and the section that I'm going to tell you about in lecture 5, and then you can focus on that, and you'll be fine. Right? You'll be fine if you just read the textbook. So that's important. So that's going to be sort of lecture 5 is what we're going to do there, and then in lecture 5 and 6, the second half of 5 and the whole of 6, we're going to introduce this topic of net realizable value. Now, this again is a very important topic. It's net realizable value is a test that we do, right, for inventory. It's a type of test that I'll explain it in detail later. But what I've noticed is that students often forget to do the net realizable value part of a calculation. They always forget it in tests and exams, and they just lose out marks, right? There'll always be between 2 and 5 marks to do an NRV test, right? And the problem is there's so many students that don't do the NRV test and they lose those marks. And those are really easy marks because all the information comes directly from the question. So will we be asked in depth? No, we're not going to ask you in-depth questions on FIFO, WAM, and specific identification. However, if you don't know it, you're going to struggle. When is this NRV test again? So you do it at the end, right? At the end of the year, or when there's an indicator. I don't know. I'm not really understanding the question, but you tend to do it at the end of the year when there's an indicator, and we're going to do it in lecture 5 and 6, and it might even pull over into 7. So it's a big section, so it might take a while for us to get it right. But we'll continue going until we do get it right. So it's going to be second half of 5 and the whole of 6, and maybe a little bit of 7. But the idea by the time we get to lecture 7 is that I want to be on this last learning outcome, which is the disclosure section, right? And so this is not like revenue where we didn't do any disclosure. We are doing disclosure here, so you need to expect that I'm going to ask you disclosure in your testing exams, right? So things like the inventory note is now super important, right? Things like what does the cost of sales look like on the income statement is going to become super important. So you need to be ready for that, and that's going to mainly happen in lecture 7. In lecture 7, yes, we're going to be talking about manufacturing entities. Okay, we're going to do that today, in fact. Okay, so let's talk about what we're not doing. Now we spoke about what we are doing. What aren't we doing? So in this chapter, right? So this is a big chapter. Chapter starts at page 166. I mean, sorry, 661, 661, and ends at 720. So it is a chunky chapter, right? There's a lot happening. It's about 60 or so pages, but we are doing it over 2 weeks, which is nice. There's only these topics that we're leaving out, right? So we're only going to leave out finance costs, right, which is like a page, and then joint and byproducts, which is also like a page. So the majority of this this chapter is going to be important for us, right? So everything else is fair game, and you need to know everything else. So just keep that in mind when you're studying. That this chapter is a big chapter, and we're going through the majority of it. It's not like revenue where I had like a long list of things that you guys must leave out, right? There's very few stuff that you need to leave out in this chapter. Okay, right. Now, let's get down to business. So the first outcome sort of that we had was that we wanted to understand what is inventory. How do we define inventory, right? What is inventory? And we said, okay, inventory, let's have a look at the definition of an asset, right? And you guys are experts at this because you guys have done the framework with Ms. Smith. But you guys will know that the definition of the asset is, it has to be, there has to be an economic resource or economic resource controlled by the entity as a result of past events. So if we look at that and we say, okay, so is there a present economic resource, right? And the answer is yes, there is an economic resource, and that is the right to sell the inventory and gain money from it and gain benefit from it. So it does represent an inflow of economic benefit, right? So there is that representation of an inflow of economic benefit. Then when we look at control, and we did control in the last lecture, I think it was, or it was the lecture before that, I can't remember, but control, we talk about, can the entity use the inventory? Can the entity gain the benefits that are encaptured in the inventory, and can they prevent other people from using the inventory? And the answer to all of those questions are sort of yes, they can do that. And so definitely the inventory then is controlled by the entity. And then the question is, what are these past events that gave rise to the inventory? And the answer is that the buying or the purchasing of the inventory is the past event, right? And that gave rise to the inventory. And so we can see that inventory is an asset, right? It is an asset, and therefore it will be classified as such on the balance sheet. The next thing that we want to ask is it current? Is it a current asset? And so the idea with inventory is that we buy the inventory and we try and sell it as soon as possible, right? And notice very carefully the standard says within a financial year, And that's obviously because a financial year doesn't always need to be 12 months, right? You can have a financial year that's like up to 16 months. But so the idea is that we convert the inventory into cash or into money within a financial year, right? So we need to ask ourselves, is that the intention of the entity? Is the intention of the entity to convert inventory into cash within a financial year? And I think if you ask most business owners, if you ask most business people what their intention is with inventory, they want to sell the inventory as soon as possible, because the sooner they sell the inventory, the sooner they can start selling a different inventory, right? So the sooner they can make more money. So their intention is always to try and sell it as soon as possible. And so as a result, we can say that we can sell it then within a year. Okay, we can sell it within a year, and therefore that makes it current. There will be some situations where inventory cannot be sold within a year, right? And then we need to ask ourselves, is this held as an investment? Are we holding the inventory as an investment? And I think you can accept that if it is inventory, if it's goods and services that we're trying to sell, then it will never be held for investment purposes. It's always going to be, it's only going to be that the system or the process that we have in our company means that we're unable to sell it within a 12-month period. So it's still within the production cycle. So you can have a production cycle that's slightly above 12 months that might result in things sitting around for a little while, but the intention is still there to try and sell it as soon as possible, right? So it will always be classified as a current asset. Okay, now we got our first sort of example, right? And this is a very popular example, and you'll see it a lot. But the example is a building. Okay, so we've got this building, right? And the first person that buys the building is a company that buys and sells buildings. So they flip it. You call it flipping buildings, right? So you buy the building, you renovate it, and you sell it, right? So for that company, that building will be considered inventory, correct? Your answer in the chat now. Do you think that that building will be considered inventory? Right? So if I buy a building and the purpose that I have of the building is to sell it, and the answer is yes, it will be considered inventory. But now let's say you have a company that makes computers. So they buy that building. They buy the very same building, the very same one that we were just talking about. They buy the building, but their main purpose with the building is not to sell it, right? Their main purpose is to use it for manufacturing computers or laptops, right? Because their business is to sell laptops, right? And with this entity, what you'll find is they will classify the building as what? PPE, right? So it will go under IAS 16. Okay, it will go under IAS 16. It's classified as PPE. And then I don't know, I don't believe you guys are aware of the next standard that I'm talking about. But what you will see is that when you buy a building with the intention to rent it out, right? There's a standard that governs that, and that standard is called IAS 40, investment property, right? And basically you're buying it as an investment. Okay, so you can see the one building, the very same building, can be classified as inventory, can be classified as PPE, and can be classified as investment property, right? The only thing that changes is the purpose that the entity has bought it for, right? What is the purpose that this entity has bought the building for? Okay, so let us say that differently. If we have purchased an asset, right, and the purpose of the asset is in our ordinary course of business to sell the asset, right? If we're planning to sell the asset, That is our ordinary course of business means this is what our business does. This is how our business makes money, right? We buy and sell buildings, right? Or whatever. So if that is the purpose that we bought it for, then it would be considered inventory. Okay, so if we buy something and within our ordinary course of business we buy and sell this asset, it's then considered inventory, right? So this is very different from a company that their ordinary course of business is to make laptops, but they bought a building and they might even end up selling that building within a 12-month period or whatever, right? But that's not their main business. Their main business, their ordinary course of business is to sell laptops, and therefore it would have been classified as PPE. And then when you sold it, you would make, you wouldn't put it into revenue, you'd put it into an account called profit on sale of land and buildings, or profit on sale of property, or whatever, building, whatever, right? So you wouldn't put it inside revenue. So with inventory, whenever we make a sale, it affects revenue, right? So inventory is meant to affect revenue. And then obviously with PPE, if you're buying it for the purpose to use it as a plant, then it will be PPE. And if with investment property, if you're buying it as an investment, it will go under investment property. So the key is that we need to identify the purpose. So the first thing you need to do when you get a question, especially in test 2 and 3, so you don't need to worry too much about test 1, because in test 1 you're not doing any other assets, right? But by the time you come to test 2, you would have already done inventory, PPE, investment property. You would have done all of these assets already. So you need to be super careful from test 2 and 3 what the purpose is with the asset. Okay, you must understand the purpose and why is this person buying it, because then that will affect how you treat it. Okay, right. So that's our spiel about assets and inventory. The next thing I want to talk about is what we use inventory for. Okay, so we have sort of different types of inventory. Okay, the first type of inventory is where we just buy it and we sell it. We don't do anything with the inventory, right? We only buy it, we store it for a short period of time, and we sell it, right? That is sometimes referred to as merchandise or goods, right? So you'll hear me in class often say goods, right? So their ordinary course of business is not to change the inventory in any way. It's just to buy it and sell it, and that we often talk of a retailer when we talk of someone that just buys and sells, right? A retailer or a distributor or warehouse. That is what that is. They don't do anything to the goods. They only buy and sell it. So that's like if in our example, that would be our Checkers, our ShopRite, our Pick n Pays. Though they just buy things, they put it on the shelf, and we go there and we purchase it. Right? They don't change it in any way. The next is manufacturing entities. Now, manufacturing entities, their main purpose is to change the goods and services. What we like to say is they're going to add value to the goods, right? So they're going to add value to the goods. So they buy the goods and it's at a low value. They do something to it, and now they sell it for a high value, right? So they are adding value to the goods. And we call that manufacturing. Okay, with the manufacturing entity, you're going to find that they're going to buy what they call raw materials, right? And the raw materials are going to have a low price. They're going to do something to it, and we call that working in progress, or work in progress. Means I'm doing something to it, right? And then they're going to create this thing called a finished good, and the finished good is going to have more value than, or should have more value than, the raw materials because of what we did to it, right? So with manufacturing, you're going to find that the inventory balance is going to be split between those three subcategories, right? So raw materials, work in progress, finished goods. But you guys know that. I'm just explaining it to you again. And then the final type of business that we're going to look at is a service business, right? And a service business is a business that doesn't provide goods. They only do a service, like the person that cuts your hair, like those types of things. And with the service businesses, when they provide the service, we can't say that they provided us a good, so we won't have inventory, we won't have raw materials, work in progress, and finished goods. Instead, we have this thing called consumables. So what is consumables? What are consumables? Consumables is a type of asset, right? It's in the realm of inventory, but it's not exactly inventory. It's a type of asset that is used in order to support the service that is being provided. So, for example, the example that we like to use is at the university. So students come to the university to, they don't come to the university to find a girlfriend or boyfriend. They come to study, right? So they come to the university to study. What is that? That studying is a service, right? So the university provides a service to the students, right? In that they ask them to, or they teach them different things, right? And you learn. The act of teaching is a service. So the university provides services. And then within the university, we have what we call the cleaning staff, right? The cleaning staff will have things like detergents, they'll have mops, they'll have all of these things that they use to clean the university. But the question is, are the students coming to be in a clean environment, right? Are they? So consumables is a type of asset, right, that supports the performing of the service, right? It doesn't form part of the finished good, right? So with raw materials, the difference between raw materials and consumables is with raw materials, a part of the raw material ends up in the finished goods. With consumables, no part of the consumable ends up in the finished goods. Does that make sense? So in our example with the university, the cleaning materials is a consumable, right? The cleaning materials is a consumable because students don't come here to be in a clean environment. It would be nice if the environment was clean and the lectures were clean and the chairs and all were clean, but that's not the purpose of why they came here. The purpose of why they came to the university was to study, was to learn, was to be taught, right? So, the cleaning materials is just supporting this system of studying, the system of teaching and learning, right? It's not the purpose for why you came here, right? It's not the main meal. It's like a side dish. Having a clean environment is not the main purpose of the university, right? It's not the university's ordinary course of business, right? Now, what about packaging? What about packaging? Let's have a look at the growth in packaging, right? So let's say you go to the local Checkers and you buy some bananas, right? And so you buy the bananas and then you put it in that little packet, right? I'm sure you guys are familiar with that, right? You put it in that little packet. Okay. When you get home, do you keep the packet? Well, some people might say yes. Some people might say we don't use packets because of the environment. But anyway, the purpose that you went to the shop was not to buy a packet. The purpose was to buy the bananas, correct? The purpose was to buy the bananas. So even though you took the final good being the bananas, even though you took the final good and the packet away, the packet remains a consumable. Does that make sense? Because the purpose that you went to the store was not to buy a packet. It was to buy the bananas, right? Now, I want to switch that over and let's talk about cell phones. How many of us have gone onto YouTube and watched unboxing of cell phones, right? Lots of us have done that. And so what we've seen is that, and now we've got different types of packaging, different colors, different shapes. They open differently. They slide out. Some of them slide out. Some of them flip, and all sorts of fancy and amazing things now is happening with cell phones. And so what we see is that with cell phones and technology, the line between packaging being a consumable and packaging being the good is being blurred. Can you see that? Because number one, you can't ship the technology without special packaging, right? Number two, a lot of people like buying the the technology and then opening it and making money out of opening the packaging by selling YouTube videos and that sort of stuff. So you see that the line is being blurred between between packaging being a consumable versus being the actual good that is being sold, right? And because there's become such a cult following around certain packagings, one could argue that the packaging is actually now part of the raw materials, right? And so what is important is that you read your question carefully to identify whether we're dealing with a situation where the packaging is forming a crucial part of the finished good, right? And what you will find is that you'll be told in the question whether that is so or not, and I'll get to a tutorial question a little bit later on when we come to it, where it's a bit vague, and I'll tell you what I would have done if I set the question, right? So it's important just to pay attention to that change, that shift in thinking around packaging. So someone's asked, so basically consumables support equals some sort of support, and yes, that's the idea. Consumables are meant to support the supplier in the rendering of their services or the delivery of their goods somewhat, right? That's what the consumables are supposed to do, or packaging. Okay, now I want to look at different types of inventory again. So just from the previous slide, we can buy inventory with the purpose just to resell it, right? And we said that's a retailer. Okay, that's not too difficult. We said we'll call that either merchandise or goods for resale or something, right? So that's what that is. Then consumable stores, as we said, consumable stores are sometimes known as materials supplies. They can sometimes be known as packaging. And the key between a raw material and a consumable store or consumables is that the relationship to the final product is indirect, right? Their relationship to the final product is indirect, right? So they're not involved in manufacture, right? They shouldn't be involved in the manufacture. Okay. What that means is that because it's not involved in the manufacture and because it doesn't form part of the final good, right? Consumables don't form part of the final good, it means we cannot recognize it in cost of sales. Okay. So you guys have got to remember that revenue, which we just finished, has its own standard, right? But the second most important number on the income statement is cost of sales, right? But cost of sales doesn't have its own standard. Instead, when we're doing this section, the inventory section, we are in effect studying cost of sales as well, right? Because remember, inventory will become cost of sales. So keep that in mind. So with consumable stores, because we can't include it in the inventory balance, right? It has to be shown as a separate balance. This means that we can't include it in the cost of sales. Instead, it needs to be an expense item on the income statement. Okay, where would the consumable? So someone's asked where would the consumables be used? So in the same vein, cleaning materials for the factory is a consumable, right? Then one can say, like tea and coffee for the workers, for the factory workers, is a consumable. It's not directly linked to the production of the goods and services, but it helps the process, right? If we provide tea and coffee, the workers are happy, they produce more, whatever, right? So that's an example of a type of consumable in the production process. I think that's what you are asking. Where would the consumables be used? in the production process. Yeah, so it will be like cleaning, things like tea and coffees, those sorts of, you know, outside things that are not directly linked to the consumables process. So the lecture slides were uploaded weeks ago under the learning area. They are a sort of so someone's asked a very tricky, very tricky question. They are a sort of overhead, right? They are a sort of overhead. Consumables are a type of overhead, but they are not as far removed. It's strange. Because there's actually some asset sitting somewhere. And it's not, for example, like rent, right? Because rent is also overhead. It's not it's not like rent. So as a result, we have to record, if we're receiving some sort of asset, we have to record it somewhere, right? If we just, let's say we go and buy snacks, we've bought the snacks, we have to pass a journal entry for it. We can't, and it has to appear on our balance sheet. We can't not do that. And so as a result, the difference between sort of rental expense and consumables is that consumables actually sits in some type of asset. It actually sits in some physical asset, whereas rent doesn't have a physical representation. Okay, so rent is like an agreement. Okay. Okay, wait, we didn't finish that slide. So that's consumables, right? That's sort of what we chatted about. Then we've got this other component, which is called raw materials. Now, raw materials can sometimes be referred to as direct materials or direct material costs. And basically, raw materials is the item or the asset that is used in the production cycle. Right, so we did something to the raw materials in order to get the finished goods. So it's directly linked to the production cycle, unlike consumables, which is indirectly linked to the manufacturing. So that's the difference between raw materials and consumables. Okay, then once we've done something to the goods, to the raw materials, and let's say they're incomplete, we can then call them work in progress, right? So these are incomplete finished goods. The goods that are still being processed are called work in progress. Then once they're finished, entirely finished, then we can call them finished goods, right? Goods that are entirely completed are then called finished goods. Any questions so far? Okay, I just want to talk quickly. Remember, we said we're not going to talk in detail about periodic and perpetual, right? But we're just going to touch on it just slightly. The first thing that I wanted to just mention is that the perpetual inventory system is very popular in practice, right? So you'll find that the vast majority of entities in practice, when I say in practice, I mean in the real world, are using the perpetual inventory system, right? So the perpetual inventory system on your slides is everything in black, right? The periodic inventory system is only ever used by very small companies. When I say very small companies, I'm talking like about the spaza shop, you know, the like very, very small companies, like micro enterprises. Right, and so what's the difference? So it's in the word, right? So perpetual means that continually the inventory balance is correct. Perpetual means always, right? So the inventory balance is always correct. That's what perpetual means. Periodic means the inventory balance is only correct at specific periods of time. That's why we say periodic. It's only correct at specific times of the year, right? And so let's talk a little bit about why that is, right? So the first thing is with the perpetual inventory system, we use this account called inventory account, right? And so that inventory account can be broken up into three different parts in a manufacturing industry. And those three parts can be the raw materials, work in progress, and the finished goods in the manufacturing industry. But obviously, in the retail industry, it would just be um, inventory, right? We wouldn't label it anything else. It'll just be inventory. And so basically, as soon as we make a purchase, we know what is in the inventory account. And then as soon as we make a sale, we take it out of the inventory account. And as a result, it's constantly up to date. Right? It's constantly up to date. We always know how much is in the workshop, basically, how much is in the storeroom. We should always know with the perpetual inventory system. And that's why I say here that it's updated in real time, right? So it's the update is in real time. And what we've noticed is of late, smaller and smaller companies are able to implement the perpetual inventory system. And this is because we found that there's a large amount of technology take up in the space, right? So we've got what we call inventory management systems that have become quite complex with the use of barcodes and scanners, and recently a lot of robotics has come into the space of inventory. And so you'll often find, like in the big retailers, there's not much human interaction. Humans are being put out of work, right? The humans are not having a job anymore because the robots are able to pack the shelves. They're able to move things around and that sort of stuff. So you'll see this a lot in the Americas and in Europe, where, for example, like Amazon has entire factories that move tons and tons and tons of inventory a day, right? Hundreds of tons of inventory a day, and there's just a skeleton staff of 5 or 10 people that work in the entire factory, right? And the robots do everything else. So as a result of this high level of technology, high level of computerization, we found that more and more people are able to implement the perpetual inventory system because the controls are so much better, right? Meaning that it's not easy for them to lose inventory. It's become much harder for them to lose inventory nowadays, right? So that's the perpetual inventory system. When we talk about the periodic system, with the periodic system, we don't know how much is in the warehouse at any given time, right? It's hard for us to estimate it. And that's because there's sort of a disconnect between purchases and cost of sales, right? So in the perpetual inventory system, there isn't that disconnect because the inventory account and a cost of sales account are constantly speaking to each other, right? They're constantly communicating. Whereas in the periodic inventory system, that there isn't that constant communication, right? They only sort of talk once or twice a year, which means that once or twice a year we will adjust the cost of sales to reflect what is happening in the warehouse. And the other thing that's important is with the stock counts, right? So under the perpetual inventory system, the stock count is used to check the balance, right? The stock count is used to check the balance under the perpetual inventory system. However, with the periodic inventory system, the stock count is used to determine the balance, right? So things like losses due to theft, due to, if there's small amounts of theft, if there's small amounts of damage and that sort of stuff, we won't be able to accurately pick up these instances with the periodic system because we don't always know what's happening in our warehouse. So like I said, the balance of inventory is accurate at a point in time, right? It's not all the time, and it's often used by very small industries, and the times of the year that the periodic balance is accurate is generally at the middle of the year, right, where we have our interim audit, and generally at the end of the year when we have our year-end audit. That is basically the only time that the periodic system is up to date. Okay, I just want to quickly chat to you guys about some of the journal entries that we might see in the periodic inventory system. So the first is you'd find, like, at the beginning of the year, what we would do is we would move whatever the inventory on hand was at the end of the year. We'd just move it into cost of sales, right? And it would just stay there, right? And so we would assume that we're going to sell whatever was on hand at the end of the year, and we just move it into cost of sales. And then during the year, we would make purchases, and then we would sort of move those purchases into cost of sales. But then at the end of the year, we'll do a stock count, and whatever we find that is on hand, we will then move it out of cost of sales and put it back in that asset only for the year-end period, or for the interim period if it's an interim audit, right? We basically create this inventory asset or inventory account only for those periods of the year, and we'd keep the stuff in there that we've counted, right? And so it's a very disconnected system, and a system that will not be able to pick up theft or damage, right, or loss in some way. Whereas the perpetual inventory system is a lot more accurate, right? So the perpetual inventory system, we would have all purchases that we make would go directly into the inventory account, and then if there is a situation where we sell something, we would obviously do the revenue transaction here, which is something that we would done in the previous lectures. But then this is the one we need to focus on. For each and every sale that we make, we would then debit the cost of sales and credit inventory, showing the decrease and the sale of inventory. So that this is the important part, and this is the part that helps us to keep our inventory balance up to date, is because we're constantly passing these journal entries for every sale that's made. So these are the important journal entries in inventory in the perpetual system. Now this is important, guys. Guys and girls, just keep this super front of mind. The perpetual inventory system is not used very much, right? And what you will find is in your tests and exams, we also try and mimic what is happening in practice, which means that you're not really going to get, sorry, did I say the perpetual inventory system is not used a lot? I meant to say the periodic inventory system is not used a lot in practice, which means that we are trying to mimic what's happening in practice. And so you'll rarely see the periodic system coming through in your tests and exams, right? So in your tests and exams going forward, you'll often only see perpetual, and the periodic won't even be mentioned, right? So the key is that you need to assume going forward that it's always the perpetual inventory system, and you won't necessarily be told that it's the perpetual inventory system. You can assume that it is, because we won't test the periodic inventory system in detail or at all. Okay, cool. Okay, so we're a few minutes early. I'm going to take a 5-minute break now, and then we will be back at 1:27, right? So 5 minutes from now will take us to 1:27, and I'll see you then. Okay. So I was just thinking I should let you guys know. In the previous lecture on revenue, you guys would have seen a little dollar sign with a man trying to press on it, and that was because it was revenue, right? Um, in this series of slides, the idea is that inventory is the key piece in a business, right? So it's the main puzzle piece in a business, and so that's why we go in with inventory. And for example, a business will not operate without inventory. And that's why we're using the whole puzzle theme. And then the other thing is inventory is the only part of a business that has very little or no interaction um, with anything else outside, right? So, for example, sales, there's always going to be the customer, right? Creditors, you're always going to have the creditor. Debtors, you're always going to have the debtor. Whereas inventory is sort of a balance that is almost entirely inside an entity. And so that's why I've used like a puzzle that has no edges. It's all, it has to fit into the rest of the puzzle. There's no edges to it. So I just thought I should explain that so that you know there's a lot more thought than just the madness that happens. Okay, cool. So let's just talk a little bit about the second part of inventory, right? So now let's see what we've done so far, right? So far what we've done is in lecture 1, we spoke about whether inventory is an asset or not, right? Cool. You guys remember that? And then we spoke just briefly. We didn't spend a lot of time about the periodic and the perpetual inventory system. That was basically what we did in section 1, right? That was what we went over in part 1. Now, in outcome 2, what we're going to try and do is we're going to try and start to build costs, right? We're going to start off with purchase costs, and we're just going to touch a little bit on conversion costs. We're going to finish conversion costs and other costs Thursday, Friday, right? So that's what we want to do in today's lecture. We want to try and just get past purchase costs and just touch on conversion costs, right? So let's see what this looks like. Okay. So when we're talking about costs, guys, the cost of purchase is going to be the cost that we are charged by our supplier, okay? It's the cost that we are being charged. Now, the key thing about this cost is that it has to be cost that we cannot be refunded in any way, right? We can't get it. We can't get a rebate on it. We can't get a discount on it. We can't get all of those things on it. So any amount that we can claim back or that we don't need to pay will not be included in the purchase price. Now, oh, I forgot to tell you about the key principle. Right, so write this down somewhere. Right, this is the key principle for the rest of the lectures on costs. Right, the key principle is we want to include costs. So include means we add. Right, let me highlight it. We want to include costs, right, that bring the inventory to a sellable state. Sellable means you are able to sell it, right? We want to include costs that bring the inventory to a sellable state. Okay? Everybody happy with that? Have you all written it down on a page somewhere? Right? This is the key principle, the key concept, and I'm going to keep coming back to this principle, and I'm going to expect you to answer in the chat, right? So I'm going to ask you, does it bring the oh, so someone said, can you repeat that? The principle behind accumulating costs, right, is that any cost that brings the inventory into a sellable state must be included in inventory. Sellable state means a state that can be sold, a state where it can be sold. Does that mean transport to the business, then to bring it to a sellable state? Yes, transporting inventory to our factory brings it to a sellable state. But then, so let's just talk, because a lot of people like this conversation over delivery costs, right? So let's say we've got a factory, right? Um, let's say we've got a factory and we need to get the raw materials to our factory. So we pay for transportation to bring the raw materials to our factory, right? Um, that is a cost that we are incurring to get it into a sellable state. Okay, that is the cost that it's bringing it to our factory, right? But the when the goods are finished being manufactured, so now they're sitting in what we call finished goods, can we sell the finished goods? What's your answer? Can we sell finished goods? Yes. So is it already in a sellable state? Yes. Therefore, when we deliver it to the customer, right? When we deliver this finished goods to the customer, that is not a cost incurred to bring the goods to a sellable state, because that has happened after it has reached a sellable state. Does that make sense? Right? So transporting the goods from our factory to our customer is not a cost that we will include, you see, in the inventory. Right? Okay, so that's why a lot of people get confused with the delivery costs. Delivery costs that are bringing it to our factory and that are bringing it to be manufactured are costs that must be included. But delivery costs that are taking it away and going to the customer is not included in the cost of inventory, because at the point it left our factory, it was in a state that someone could have sold it. Okay. Right. So we're going to keep coming back to that. I just want to go back and just have a look at the chat, because there were a few chats that I think I might have missed. So someone asked, I think, what is a sellable state? Sellable state means it's a state that can be sold. Does the transport to the business then bring it to sellable state? Yes. To bring the goods into our business, into our factory, means we are working on bringing it into a state that it can be sold. So someone said, so is that the same as its present condition? Yes. So management, you got to ask yourself, what condition does management want inventory in, right? Management wants the inventory to be able to be sold. They want it in a sellable state. So yes, that's exactly what we're saying here. Is it not already sellable without the transport? No, because it's a raw material, so we can't sell it without the transport, right? We'll assume that it's a raw material, or even like someone else has answered, you can't sell it if you don't have it with you. You shouldn't be selling things that's called fraud or drop shipping, right? Anyway, I don't think so, because you don't have it. Yes, someone said that. Yes, I understand that part, makes sense. Do you deduct normal spillage? No, you include normal spillage in the cost of an entity, right? So it will be included in the cost of inventory. You don't deduct it, you include it, right? That's why it's on the included side. When we're going to talk about that just now. I just wanted to deal with transport. When transport costs to the customer, we put under carriage on sales. Then it would be put carriage on sales. I would rather say selling expenses, right, or delivery costs. Selling expenses or delivery costs. That's where transport to the customers must go. I do repairs and maintenance, ground maintenance, second hand cars to be resold. be considered a cost. The question that you need to ask yourself is, can the car be sold before the maintenance? Is it possible for the car to be sold before the maintenance? If it is, then it won't be a cost um, that's incurred in getting it to a sellable state. But if you can't, right? So if it's a repair, then I would say yes, okay, it's a cost that we must include. But if it's just normal maintenance, I don't know if we can include that as a cost um, uh, uh, to sell it, right? Because there's a difference between repairs and maintenance. Repairs is to restore something to a previous condition, whereas maintenance is just to make sure it's still working. Okay, so someone said, so if we manufacture 50% of the goods at a certain location, then another 50% is manufactured at a different location. The transport cost to move it from one location to the next is included. Yes. So yes, if within the production process, transport costs are incurred, yes, it will be included in the cost of an entity, in the cost of an inventory at least. It will be included. So if within the production process you need to transport it, it should be included in the cost of the inventory. Okay. Now let's go back to our lecture. So we had to stop and do transport costs because we love transport costs, right? Everyone loves transport costs. Okay, let's talk about purchase price. So when we're paying for something, right? Um, Obviously, that is going to be included. I mean, I don't need to talk about that. Now let's talk about import duties. So import duties in South Africa, you are unable to claim back, right? So the import and custom duties, you're unable to claim it back from the government, right? So it's a tax that is non-claimable. Therefore, it must be included in the value of inventory, okay? Because it's non-claimable. What tax in South Africa is claimable? Pop your answer in the chat. What tax in South Africa is claimable? VAT. VAT is claimable. Why is VAT claimable? Okay, because we pay input VAT, right? And then we pay input VAT rebates. Rebates is not a tax. We pay input VAT, and then when we sell our goods, we charge output VAT. We only are going to pay SARS the net of the two. We're going to pay them the net of input and output VAT, right? So in that sense, we are claiming back the input VAT. Does that make sense? So as a result, VAT is never included in the cost of inventory, and that's why we got it on this side under non-include, under exclude. Okay. Let's talk about landing costs. So the cost, landing costs, similar to transport costs, is costs that are incurred to bring something to a specific location where we like to our factory or to our. So it's an inbound delivery cost. Inbound meaning it's coming into us, right? It's an inbound delivery cost. Landing costs, handling costs, those sorts of things are costs incurred to bring it to us, and therefore they will be included. Why? Because they are a cost incurred in the process of making this thing sellable. Now, what about normal spillage? Think about normal spillage. What does that? So just so that you know, I want to direct you to the frequently asked questions on ClickUp under this learning area. You're going to see there's a section for frequently asked questions. There's tons of students that keep asking me, is normal spillage the same as normal wastage? Right? That question is answered there, and the answer is yes, it is the same thing. Right? Normal spillage and normal wastage is the same thing, just like abnormal spillage and abnormal wastage is the same thing. Right? So normal spillage is so why are we saying it's normal? Right? Because our process of manufacture can never eliminate the spillage or this wastage. What exactly is spillage or wastage? It just means in the normal production, right? inefficient production, certain goods and certain goods, raw materials, will be damaged to a state where we cannot use them anymore, right? And that's normal. That's how it's supposed to happen, right? That's how, there's no way to eliminate that, right? And so that's why we call it normal spillage. Now that would be a cost that would be incurred, right? That is a cost that is incurred in bringing the goods to a sellable state, okay? And it's not an abnormal cost. It's not a cost that is strange or shouldn't have been incurred. It's a cost that we know we should incur, right? So therefore, normal wastage is included, but any abnormal wastage is removed, right? Is removed from the cost of inventory. So abnormal wastage is removed from the cost of inventory, okay? Because there's something wrong that happened. Someone was negligent, or what, something went wrong, and the question will make this, your test or exam question will make this very evident. It will say this is abnormal and this is normal wastage, and now you will have these two figures and you need to decide what to do with them, right? It might even say, this is the total wastage, and let's say the total wastage is 100,000, whereas the normal wastage that we expect is 60,000. So then that 40,000, the difference between those two amounts, the 40,000 is going to be considered abnormal, right? And so you need to know what to do with that, right? And so the idea is that we exclude it. That's why if you have a look at the man in red, he's broken up, he's taken out. We must take it out of inventory, of the cost of inventory. We can also have some insurance. So certain types of products like gold and that sort of stuff, you can't keep them without having insurance. So they're incidental to the holding of gold. Other taxes that we cannot claim, right? So unclaimable, unreclaimable taxes. Then I say transport inbound, or inwards, and then any assembly costs, right? So any manufacture or assembly costs. Now let's talk about what we shouldn't have in there, right? The first thing is any volume discounts or rebates. We should not have. Why? Because when we receive, now we're talking about receiving volume discounts and rebates, right? So when the supplier gives us a volume discount or rebate, we would not include it in the cost of inventory because we never paid that amount. It was not incurred, right? We never paid that cost. So therefore, we won't include it in inventory. In a similar sense, when we issue a discount, or when we issue a rebate to our customer, that cost was not incurred in bringing the inventory to a sellable state. So discounts that we offer to our customer, or discounts that we offer to our or rebates that we offer to our customer, those are also not included. So we don't include the ones that we receive, and we don't include the ones that we issue out. The difference between landing costs and handling costs and inward costs, they're all the same. They're just different ways to write them. So for example, landing costs would be the sort of costs to get a shipment to the harbor, whereas transport costs can be classified as all of the costs, right? All of the costs to get it to your door. Landing costs is just to get it to the harbor. Then you might have handling costs just to take it off the ship. Then you might have cargo costs to get it from the ship, from outside the ship to the factory. As a whole, we would call all of those inbound transport costs. So inbound transport costs is like the umbrella, whereas the landing costs and the others are like within the umbrella. Okay, someone said shipment costs. Yeah, that's the same. Please can you explain why we exclude discounts and volume rebates? So we exclude discounts and volume rebates that our supplier gives us, right? Because we never actually incurred them, right? Because For example, if we took advantage of the discount, so that means we paid less, we never would have, it doesn't make sense for us to include it. The money never left our bank account, right? We're going to talk about a situation with a settlement discount just now where there's a bit of uncertainty, right? And we're going to talk about that in detail. Then when it comes to discounts that we issue to our customer, we won't include it because it's not a cost that we incurred to bring the goods to a sellable state. So that's why we don't include it. A discount given to you is money you are not paying. Correct. Yes, that's exactly what the right answer is. Then someone says, is the cost of storing meat in a freezer, for example, included in the cost of inventory without the freezer? Right. Now, this is, so someone's obviously been reading ahead and gotten to storage costs. Now we need to talk about storage costs. So storage costs are costs that we incur in order to store goods. Okay. Now, this is a product that is very, I'm thinking of a product now, and I want you to name the product in the chat box. It's a product that is very popular among students. Students love this product. They just love this product, right? And basically, this product that I'm thinking about is and this product is a product that you have to store it. Okay, so the guys in the chat were correct, right? I was thinking of alcohol. This is a product that you have to store in order for it to be sellable, right? If you don't store alcohol or wine or whatever for a period of time, right, you can't sell it because it won't be strong enough, or I don't know what the right word is, but it just won't ferment, right? So as a result, when you talk about alcohol, storage costs is a type of production process, right? So when you're dealing with a good where storage cost is the type of production process, right? Then you must include it in the cost of inventory, right? So if your storage cost is involved, is critical to the production process, and you cannot sell it without having it stored, then it must be included in the value of the goods, right? Now, and someone asked the question, what about meat? Right. So we need to ask ourselves, just like we did when we spoke about wine. Yes, so we're dealing with that now. So what about meat? So the question is, can you sell the meat, right, if it is fresh, if you haven't stored it? So let's say you went to the abattoir, you cut the animal, and sorry for those that are struggling with the graphic nature of our lecture today, right? So you went to the abattoir, you cut the animal. Can you sell that meat as it is, or do you have to put it in the freezer? And the answer is you can sell it, right? You can sell freshly cut meat. Can you not sell freshly cut meat? I'm sure you can. You can sell freshly cut meat, which means it is not the storing of the meat in the freezer is not a production process. It is not something that you have to do in order to sell it. And therefore, storing a freezer time for meat is not considered to be something that we must include in the cost. It's going to be excluded, and it's going to be sitting under the expenses in our income statement. Ice cream is another example, I think, of where we would need to store. So again, with ice cream, you need to ask yourselves, can you sell it if it's not frozen? And the answer is no, because if it's not frozen, it's not ice cream, right? Right? So if it's not frozen, it's not ice cream. So whereas with meat, we wouldn't include storage costs, right, in the cost of inventory. With the ice cream, we have to include it because the storing or the freezing of the ice cream is to bring it to a state where it's sellable, right? Someone says, yeah. So if you don't store the ice cream, I don't think you automatically get milkshakes. I think you just get like cream, liquid cream, if you don't store it in the freezer. Okay. Selling expenses, I don't think I need to explain that, because before the fact that we incurred these expenses, before we incur expenses to sell something, it's already in a sellable state, right? Therefore, we're not going to include it. Then Forex. So we're going to deal with the Forex example just now. But Forex is basically the difference in price that results from foreign exchange transactions. Right? And as you know, the rand to the dollar doesn't stay equal, right? It's constantly changing. As a result of that change, we can sometimes make a loss or a gain, right? And that loss or gain cannot be included in the cost of inventory. It needs to be recorded in a separate account. And that is because that specific cost was not a cost that we needed, was necessary for us to incur. Right? It is a cost that was incurred as a result of us buying from a foreign supplier. But the reason for why we incurred it was because it was a foreign supplier, not because of the inventory. Right? Okay, so we'll talk about that just now. Right, now I want to talk about settlement discount. So you get different types of discounts, guys, right? Let's list the discounts. You get trade discounts, you get bulk discounts, right? And you also get cash discounts. Those discounts are discounts where there's no uncertainty, right? You know for a fact that you're going to get the trade discount, right? There's no uncertainty with trade, bulk, or cash discounts, right? However, with a settlement discount or volume rebate, right, there is some uncertainty that we need to account for. So someone said, please repeat. Trade discounts, bulk discounts, cash discounts, there's no uncertainty. We are confident that we're going to get those discounts. The ones where there is uncertainty is settlement discount and volume rebate, right? Which is, if you remember when we did revenue, it's the same two that caused us issues in revenue that are coming back for us now, right? So it's the same to settlement discount and volume rebate that we needed to do all the extra journals for, right? Whereas the other ones like trade and bulk and cash, we just took it directly off the price. If you guys can remember, we took it directly off revenue at the beginning, and we never heard about it again. Okay, so with settlement discount and volume rebates, there's this uncertainty that we're not sure about, right? We don't know whether we're going to pay on the date that we're told to pay. We don't know if we're going to pay before the settlement date. No. So bulk discount is when you receive a discount because you made a large purchase in the current purchase. A volume rebate is when you say to someone, over the year, you're going to buy, let's say, 30,000, and if you hit that amount, then you'll get a rebate. And that's why there's a difference in that word rebate. And the rebate means you get money back, right? You need to pay it up front and you get the money back. Whereas discount means it's taken off the price. Right? So don't get confused between volume rebate and bulk discounts. Rebate, you need to see into the future. Am I going to buy so many units for this year or for this month? Right? Whereas with the bulk discount, you don't need to see into the future. They're telling you you're going to get it. All right. So anyway, so at the transaction date, there's uncertainty around whether or not we're going to pay the settlement discount, right? So the settlement discount is actually potential at the transaction date. So we now need to account for this uncertainty in our journal entries. Now I'm gonna show you how to do that. If the rebate is offered before or after the said purchases have been made. The rebate is always offered before. Rebates are generally always offered before the purchases have been made. Okay, now there's a very important man that we're going to meet. This man is from 1990. No, he's actually from 2004, right? And you can see that by the lovely cell phone that he's got right there. That cell phone was, that's called a Nokia, I think it's called a Nokia N70, right? And what this man is trying to tell us is that we must turn to page 675. So let's turn to page 675, right, in our textbooks. And he's saying you must never use option 1. So on page 675 at the bottom, you're going to see option 1 at the bottom of the page, right? In back to 100, we never, ever, ever use option 1, right? So option 1 is basically saying that we don't account for the uncertainty at all. We just assume that we're always going to get the discount, but we need to account for the uncertainty. All right, so let's see. Give us a practical example of how to do. We just chatted about volume discount and bulk discount. So bulk discount, they say buy 3 and pay for 2. That's a bulk discount. A volume discount, a volume rebate says over the year you need to buy 10,000 units and then you'll get a rebate. That's the difference. Would it be uncertain then because you are not sure if you're going to buy? Yes, that's why it's uncertain, because you're not sure if you're going to buy the specific number of units by the end of the year. Yes, exactly. Yeah. So the volume rebate, you never know if you're going to get it. That's why there's uncertainty. Okay, so is everybody happy with what this man is saying here? Right? The man is saying, do not use option 1. Never use option 1 in your textbook. If you turn over the page, you're going to see option 2. That is the only thing that we are going to use. Right? Now, the problem is there's a lot of people who are not going to come to the lecture, so they won't know not to use option 1. Right? Now, they're going to go to their testing exams, and they're going to use option 1 in the testing exams, and they're not going to get the marks. Okay? That's a problem. So please don't use option 1. You're going to lose marks if you use option 1. Okay? You must use option 2 only. Okay, let's have a look at what option 2 looks like. So option 2 says that the creditor's control must always be at 100%. This looks very similar to what we did with revenue. Remember, the debtor was always recorded at 100% of the transaction price. And then we used to record the debtor at 100%. Then the revenue used to be at the amount less the discount, and then we used to have this allowance, right, for discount. So we do the same thing here. The creditor is at 100%. The inventory will now be at the amount less the discount, and then we also have this allowance for settlement discount received. We have to add this word received at the end of the statement. If we don't add it, we're going to be penalized, right? So that's critically important that we add the word received, right? So the mark is allocated for this word here, because if you don't add this word at the end of the journal entry, that means you don't know whether it's being received or whether you're issuing it, right? So just make sure that you put the word received in your testing exam, right? Obviously, one of two things can happen. The first thing is that we can pay within the discount period, which means we get the discount, we achieve the discount, and then we receive a reduction in value. Or the second thing is we pay after the discount period, which means we lose the discount. What happens when we pay within the period? So what happens in option 1? What would happen is that we now need to decrease the creditor, because remember the creditor in the previous slide, we said the creditor is recognized at 100%. So we now need to decrease the creditor to an amount that's less the discount, right? So amount excluding the discount. And we do that by netting off the allowance account, which we just created. Remember we said that's a suspense account, right? we net off that allowance account against the creditor's control account, right? And that brings the creditor down, and then we are able to pay. Okay. If we don't pay within time, we then need to take this settlement discount allowance or rebate, volume rebate allowance, and we then need to increase the cost of inventory, because now it becomes a cost that is incurred in order to make something sellable, right? It's a cost that we now have incurred. And so there's no uncertainty anymore. We now know that we've incurred it. And so therefore we increase the inventory balance with this discount. Let's have a look at that in an example. Okay, in this example, Cool Limited, it's on ClickUp. I'll put it in a Word document as well, just in case you want to do it and the slides are not, and you don't like doing it on the slides. So I'll put it in a Word document for you guys. Okay, so it says on the 10th of May 2017, Cool Limited purchased goods on credit from Hot Limited. The following information relating to the transaction is available, right? So the transaction price was 800, right? So that was the price of the transaction. Then they offered us a discount, a settlement discount of 10% if we paid within 20 days, right? If we paid within 20 days. Okay. So what is the journal entry going to look like on the transaction date? What is the journal entry? Remember, let's look back at this one here. We know that we want the creditor to be at 100%. So 100% of this transaction would be 800 Rand, right? Let's go back to our slide. The inventory needs to be at the amount less the discount, right? So we want the inventory to be at 800 times 90, right? And then finally, we're going to create this allowance for settlement discount received. So let's have a look at that. That's what we can see here. The inventory is debited, which means it's increased, and it's increased for an amount less the discount, so for 90%. We've then got the discount received, which is now here, right? At 80. This is a negative liability. Remember the last one we looked at was a negative asset. This is a negative liability, right? So it works in the opposite way of a liability, but when we present it on the balance sheet, it has to net off against the liability. That's the idea between the negative elements, right? So remember the negative asset that we dealt with in revenue, it works in the opposite way as an asset, but when we present it, it must be net. The two amounts must be net. Same story here, negative liability. We've got the settlement discount received of 80 Rand. When we present it, it'll be netted off against this creditor, which is recorded at the full 100%. Any problems with that first journal entry? Anyone want to ask a question about the first journal entry? Everyone seems quiet. Okay. Right, so the second journal entry, we pay within 20 days. So now we take advantage of the discount, right? We take advantage of the discount. Let's have a look at what happens. The problem is when we take advantage of this discount, we have already recorded the creditor at 100%. So we need to find a way to decrease the creditor. We do that with the first journal entry here. We reverse the allowance, right? So we actually debit the creditor, which means we make the creditor smaller, and we credit the discount received, right? The allowance for discount received, which means we get rid of it, we eliminate it, we kill the discount received, and what we then do is we reduce the creditor, right? Obviously, bank, the money going out will be net of the discount because we took advantage of the discount, and the creditor then will be eliminated with the 720. And now at the end of the whole thing, the creditor is at zero, right? The creditor's balance is zero at the end of the whole story, right? Now let's have a look at what happens if we don't take advantage of the discount. We pay after the date, right? If we pay after the date, we now need to move this discount received into inventories, right? So we move it into the cost because it's now incurred in bringing this inventory to a sellable state, right? The idea being that at the end of the transaction, the settlement discount received must always be at a nil, must always be zeroed out, right? And the creditor must also always be zeroed out, right? And if you look at this, we can't pay 720 anymore. We have to pay the full amount of 800. And so we credit bank for the full amount, and then we can debit the creditor for the full amount. Okay, someone's asked, why do we record inventory on payment? Why do we record inventory on payment? Okay, was it not recorded on the date when we purchased the stock from the supplier? So when we purchased the stock from the supplier, which is the first journal entry, this is the transaction here, we left out a portion that related to the discount received, right? We left out this 80 Rand and we put it in this negative asset, which we call a suspense account, an account that is attached to the creditor, right? We left out the 80 Rand. Now, in scenario 3, or in required 3, remember required 3, we did not take advantage of the discount. We paid after the 20 days. We now need to add it to the inventory. Yes, a suspicious account. That's what it is. Okay, we need to add it to the inventory. So that's why we're debiting the inventory now, because it's now become a cost that we've been forced to incur. Right. Does that make sense, Nicholas? Just tell me if you understand. I'm going to move on, but what I want you to do as sort of homework is I want you to go back and have a look at your revenue slides and your revenue lectures and see how we treated settlement discount allowed, and then how we treated settlement discount received today. And you'll see that it's actually a mirror of the two, right? We're doing the exact same thing, but in the opposite direction, right? So that's what I want you to look. I want you to look out for that and see that there. Okay. We need to move on now. If you stay after the lecture, then we'll go through this example again, because I'm just worried about time. Okay. So let's have a look at Forex. All right. So with Forex, we can purchase inventory from a foreign supplier. When we purchase inventory from a foreign supplier, it means that the invoice or the inventory that we receive will be dominated in a foreign currency. That means it will be valued in a foreign currency. Right. Now we've got a problem, because our financial statements need to be in rands, right? But the transaction that we've engaged in is in a foreign currency. So now we've got a problem. We now need to find a way to translate, right, that foreign currency into rands. Okay, but the problem is the rate that we need to use is constantly changing, right? The exchange rate is constantly changing. Another word for exchange rate is spot rate, right? The exchange rate or the spot rate is constantly changing. So we need to be very, very, very careful about the rate that we use, right? We have to be super careful about the rate that we use. And I'm going to teach you how we're going to do that. So I just wanted to show you some of the main currencies that you'll see in your tests and exams. The US dollar obviously is the most popular. We've got the Australian rand, British pound, right? Because Britain is no more in the European Union, and even when they were in the European Union, they weren't using euros. But then obviously, if you trading with the euro block, then you have to use the euro. China uses the yen, right? Hong Kong, which is obviously trying to separate themselves from China, they use the Hong Kong dollar. And then you also get the Japanese yen. Okay, yuan, it's Chinese yuan. Sorry, I pronounced that incorrectly. Now, if there's any other currencies that you see in your test or exam, I will indicate to you the country that the currency comes from, and I will tell you that this is the dominant currency in that country, right? So you might see other currencies in your tests and exams, but I will introduce you to those currencies during the paper, right? So don't be shocked if you see something that's different. Right? Now, I want to talk to you a little bit about rates. Now, for now, we're only going to use direct rates, right? Direct rates are rates where the foreign currency is dominated in a one. The foreign currency is always in one unit. And you see all of the foreign currencies here are in one. So there's one US dollar, there's one peso, and there's one dirham. Can you see that? There's always one um, of the foreign currency, which then means that the rand is in a multiple, right? So you get different numbers under the rand amount. So those are the currencies that we are going to be using. We're only going to be using this type of translation, right? Later on in the year, when we start to do Forex proper, right? So this is not Forex, this is just a brief crash course. When we actually do real Forex, then I will show you what an indirect rate looks like, and we're going to start to use indirect rates. But for now, we're only going to use direct rates. How do we use it? We multiply the foreign currency by the rand multiple, right? See here, we always use the rand multiple here, right? We multiply it by the rand multiple, and that is going to give us the amount in rands. Does that make sense? Everybody happy with that? Okay, I'll take the silence for acceptance, right? Now, the key is when we're translating the rate, we have to translate the rate, or we have to translate the inventory at the spot rate, right? And I said spot rate is another word for exchange rate, right? At the spot rate on the transaction date. So what exactly is the transaction date? The transaction date is the date at which risks and rewards, another word to say risks and rewards is control, right? Control passes to us. That is the transaction date. The date at which control passes to us. Okay? And then we're going to use that exchange rate to translate it. So what you're going to see in your examples is going to be very similar to this one. You're going to see lots and lots of different rates. So if you look at the bottom of the page here, I've given you lots of different rates on different dates and different amounts, and you know this. So the job is for you to select the right rate, right, and use that rate in translation. Does that make sense? Right. So now let's see if we can select the right rate here. Right. So we say ABC Limited purchased, so I'm reading the question, ABC Limited purchased raw materials on 1 January 2018 with a cost of $1 million. All risks and rewards of ownership were transferred to ABC Limited on 1 April 2018. Right? So which date is the transaction date? Which date is the transaction date? Is it 1 Jan? So just type out 1 Jan or 1 April. Right? The transaction date here is going to be, like everyone is saying correctly, 1 April. Therefore, the rate that we need to use in translating the inventory is going to be the 1 April rate. Right? That's the rate that we're going to use. We're going to use the 1 April rate. That's the transaction date. Right. Now, once the risks and rewards are transferred to us, we will incur some costs for this asset, because now the risks, meaning the costs, is ours. All costs now belong to us, but also all rewards, meaning any income that we can get from selling the item, will also belong to us. So now they're telling us about some risks or some costs that have been incurred. Let's read the next bullet point. It says the following additional costs in respect of the raw materials were incurred on the following dates. On the 10th of June 2018, international transport costs of 50,000. right? International transport costs of 50,000. Now, this cost is a cost that is incurred to bring this item to us, right? Therefore, we have to pay for it. Does that make sense? It's an item that we need. It's bringing it to us. We already have control over the item. We have to then pay for it. Because it was incurred on the 10th, we won't use the transaction date rate. We're going to use the rate for which date it was incurred. Does that make sense? So someone's asked, if an entity buys something on credit on one day and pays on a different day, but the rate has changed, what happens? Yes, the entity will pay extra, and then they will create this thing called a Forex gain or loss. Remember we said Forex gain or losses are not included? Where's that slide? Right? It's going to create that Forex gain or loss, and that gain or loss is going to be removed from the cost of inventory, and it'll be slapped on to the creditor. Please do clarify. What should I clarify? So I think you're talking about the international transport costs. The international transport costs were incurred on the 10th of June, right? Because we have already owned that goods on the 10th of June, it's a cost that we have to pay and a cost that must be included into the cost of the inventory. And because it was incurred on the 10th of June only, we must then use the 10th of June rate. Yes. So the cost of the asset will be the price from when it was incurred, not the price that was later paid. Yes, the cost of the asset will be the cost at transaction date, right? And here transaction date is 1 April. Yeah. Okay. So back to our story. It says there were other costs that were incurred. Let me just erase this so that we can read. There were other costs that were incurred for import duties, right? And the import duties are 20,000. Can we include import duties? Yes, because we can't claim it back, right? And then there were final delivery costs that to bring it actually to our door of 100,000, which we can include as well, right? Because they're all these transport costs are inbound. You see that? All of them are inbound. They're all to bring it to us, and therefore we need to include all of it. Let's have a look at how we're going to do that. This is what we're going to do. We're going to say the 1 million times 13.9. Where did we get that 13.9? We got the 13.9 there on transaction date, right? The 1 million plus 13.9, that's going to give you 13,900,000, right? Then we've incurred on the 10th of June, we've got 50,000 on the 10th of June, $50,000, and we're going to multiply that by the Rand multiple, which is 1420, right? We're going to multiply. Oh, I just wanted to tell you now, have a look here. How do we know that this is a direct rate? How do we know that this is a rate that we must use? The dollar is in a unit multiple, in a 1 Rand unit, in a 1 unit multiple, right? Whereas the Rand is in a big multiple. Can you see that this is a direct rate? Right? Can you identify it's a direct? You identify it's a direct rate by looking at the foreign currency and seeing if it's 1 unit, right? And then you look at the Rand and to see if it's in multiple units. If you understand that, and if you can identify that it's a direct rate, then you can proceed by multiplying, right? With the indirect rate, I'm just giving you a little bit of insight, although you will not be tested on it this semester. It'll only be next semester's story. But an indirect rate, you're going to find the Rand amount. You're going to find here at the top 1 Rand, right? And then all down here, you're going to have dollar. All down here, you're going to have dollars in multiples. That's an indirect rate. But for us, for first semester, we're only dealing with direct rate. So you'll always only see the foreign currency in a single unit, not the rand. Okay, back to our story. So we multiplied the 50,000 by the rate for the date for which it was incurred. The import duties, we don't need to multiply it by anything, right? It's just 20,000. And as well, the delivery costs we included because it's inbound of 100,000. That's going to give us 14,730,000 rand, and that is the cost of the inventory, right? That's the value of the inventory. Okay, makes sense. Does everybody understand? Okay. Good. Now, what do you need to do